Between 2014 and 2018, Jeff Bezos' wealth increased by roughly $99 billion. During that same period, the value of his Amazon stock rose from about $30 billion to $129 billion. Over those 4 years, Bezos paid approximately $93 million in federal income taxes. That might sound like a lot until you do the math. $93 million on $99 billion of wealth growth equals an effective tax rate of less than 1%. Meanwhile, if you earn around $60,000 per year, your effective federal income tax rate is typically 10 to 12%. In other words, you paid roughly 10 times the tax rate that Jeff Bezos paid on his wealth growth. And it gets more extreme. In both 2007 and 2011, Bezos paid zero federal income taxes, despite being worth over $18 billion in 2011. Elon Musk paid zero federal income taxes in 2018, while worth approximately $23 billion, 3% between 2014 and 2018. George Soros and Carl Icahn paid zero in multiple recent years. This is not tax evasion, it's not illegal. Tax law and used almost exclusively by the ultra-wealthy. The three-step strategy. Step 1. Buy appreciating assets. The wealthy buy assets that increase in value over time. Stocks, real estate, companies, art. Jeff Bezos owns hundreds of millions of Amazon shares. Elon Musk owns hundreds of millions of Tesla shares. As these assets rise in value, their net worth increases, but unrealized gains are not taxed. If you buy stock at $100 and it rises to $200, you owe nothing until you sell. The difference is this: you eventually sell to pay for living expenses. Billionaires don't. Step 2. Borrow instead of selling. Rather than selling assets and triggering capital gains taxes, billionaires borrow against their wealth. Using stock as collateral, they take out massive loans at extremely low interest rates, often 1 to 3%. That borrowed money is not considered income, so it is not taxed. If a billionaire borrows $500 million, they pay zero income tax on it. If they earned that same amount as salary, they'd owe close to $200 million in federal taxes. Meanwhile, their assets often grow faster than the loan's interest rate. If the stock grows at 10 to 15% annually and the loan costs 2%, the borrower becomes richer every year while living off tax-free cash. The loans are routinely refinanced rather than repaid. Banks are happy because the collateral keeps rising in value. The IRS gets nothing.
Step 3. Die. When the billionaire dies, the final piece activates, the step up in basis. Assets passed to heirs are reset to their current market value, not the original purchase price. This erases all unrealized capital gains accumulated during the billionaire's lifetime. If stock was bought for $1 and is worth $180 at death, the IRS treats it as if it was bought at $180. If heirs sell immediately, they owe zero capital gains tax. The loans taken during life are paid off by selling a small portion of the stepped-up assets, or by borrowing again. The result? The billionaire lived lavishly on borrowed money, paid little or no income tax, passed enormous wealth to heirs, and the lifetime gains were never taxed at all. Why this exists? The step-up in basis was introduced in 1921, largely due to lobbying from wealthy families who wanted to pass fortunes to heirs without massive tax consequences. It was briefly repealed in the 1970s, then reinstated after heavy lobbying from financial, real estate, and business interests. Since then, every serious attempt to eliminate it has failed. Banks lobby to protect securities-backed lending. Investment firms lobby to keep money in the stock market. Real estate groups use the same strategy with property. Estate planners build entire systems around it. The result is staggering. Economists estimate that this strategy costs the federal government $100 to $150 billion per year in lost revenue. Over a decade, that's over $1 trillion, money that could fund infrastructure, healthcare, education, or reduce the deficit. Why you can't use this strategy? This system only works if you already have tens or hundreds of millions of dollars. Small investors can't access ultra-low interest loans. Margin loans for regular people are expensive and risky. A modest step-up in basis saves heirs very little. Most people need income, not debt, to survive. The more wealth you have, the less tax you pay. The system is regressive by design. The bottom line. This isn't about hating rich people or punishing success. It's about fairness. If someone earning $50,000 pays a 10 to 12% tax rate, someone whose wealth grows by $50 billion should not pay 1%. That isn't capitalism, it's dynastic wealth protection. Buy, borrow, die isn't a loophole. It's not a hack. It's a deliberately engineered system, protected by lobbying, reinforced by law, and inaccessible to everyone except the ultra-wealthy.
And unless the rules change, it will keep working exactly as intended.